area. We've sort of talked about value stocks and buying Berkshire and McDonald's when they're beaten down and you know the companies continue to kick butt and turn around. So let's talk about another type of stock, growth stocks, in particular looking for accelerating growth. And you know, I first you know, shame on me for not having for having these big value investing blinders on and basically spending absolutely no time ever looking at growth stocks because I'm a value guy. And I only look for beaten down stocks trading at low multiples of current earnings, that kind of thing. So on the short side is where I first started to get clued into this. And after getting blown up a couple times on certain stocks, oh, I see a guy has already joined us. So hold on. Let me just bring Guy in and see whether he wants to go now or whether he just wants to listen for a little bit, and then we'll make him live at 8:45. Hold on just a second. And Guy, are you there? Hold on. Let me turn your microphone on.
Hi, Whitney.
Hey, Guy, how are you?
Yeah, pretty good. Oh, look at all these people.
So, Guy, I saw that you had signed in and just wanted to acknowledge you were there. We were going to go through a dozen slides here on some sort of growth stocks and some data on it. Was sort of the plan, and then turn to you in 20 minutes or so. Is that
Sure.
you, or do you have a time constraint and you'd rather talk now and we'll do something?
No, that's fine. The whole hour is yours, Whitney and Glenn. Hi, Glenn.
Hello, how are you, my friend?
Yeah, pretty good.
I see Charlie back there. Hello, Charlie.
Oh, Charlie.
Charlie Munger, the bust of Charlie.
Yeah, you have my video, so I don't see me. I can't focus on it. But anyway, let's go back. Mute me and go back, and then.
Okay. We'll put you back in the queue with everybody else as just what we call a panelist on Zoom. And thanks for joining us. Let's. I'll continue here for about 20 minutes. I think we can get through this. And by the way, anyone who Guy. If you'll look on your computer, there's a little thing about raise hand. If you want, anyone who wants to ask any questions can just do click the raise hand button and we'll acknowledge them. So one of my very wise friends told me, particularly on the short side, he's like, it's okay to short growth, but it better be declining growth. Never short accelerating growth. Here, let me pull up the slides I'm talking about here. Hold on just a second. Bear with me just a second here. Exit full screen. Here we go. I need to click the button here just to pull up the right slides. Here we go. Here we go. Look for accelerating growth. Good. Okay, you guys can see this now. So let's just. What my friend forgot to tell me is the second half of the equation, which is if you should never short accelerating growth, well, that's because there's a high likelihood the stock's going to go up a lot and it's going to kill you on the short side. But then the corollary of that is well, why don't you look at going long accelerating growth? Because if it's sustainable, that stock's going up. That's a stock you not only don't want to be short, you want to be long. And you know, way too late in my investing career did this ever dawn on me, and shame on me for that. So I'm going to try and help you guys, add this tool to your toolkit earlier in your careers. Let's just look at a bunch of companies and look at what I mean by accelerating growth. So here's Salesforce.com, a stock that I was dumb enough to be short years ago, and thank goodness got out before too much damage was done. But what's interesting here is the calculation of year-over-year revenue growth on a quarterly basis. And you can see that Salesforce.com, the rate of growth slowed from sort of 2004 to 2010, but then it has stabilized, and basically every quarter for the past better part of 10 years, Salesforce.com has cranked out revenue growth that sort of seems to have stabilized here at about the 25% level. Now, this is almost a little unnatural, and in fact, this is a company that actively manages its numbers, and I'm a little skeptical of it. But this is something you do not want to be short. That is for darn sure. So let's take a look. This is what the stock has done in the last 5 years. It's up 4x. You know, the stock is up 10x or more over 10 years. This is what a great growth stock looks like, in terms of revenues and in terms of the stock price. So let's take a look at Microsoft, which just reported another strong quarter. The stock has tripled in the last 5 years. What does its growth profile look like? This is quarterly revenue growth year over year. And you can see it was negative for a few quarters back in here a few years ago. And that was actually as they moved from just pay up front to own Microsoft Office, for example. And they instead moved to a monthly or annual fee. So that had the effect for 4 quarters of reducing revenue, but it's been a big winner in the long term. It's been one of the big drivers of the stock, moving to a subscription basis, which a lot of software companies are doing. It's a very powerful driver of long-term earnings. So here's Adobe, another tech stock that's just been a monster, up 5x in the last 5 years. And here's why is the stock up 5x? Not only because they've had good growth, but because growth has accelerated. Again, I think they moved to a subscription model back about 5 years ago, and that has helped translate into huge growth. So every quarter now they're cranking out 20+% year-over-year growth. This stock is going up. Here's Amazon, which is up 7x in the last 5 years. And this is just extraordinary. This is a company with revenues now, a run rate revenues of over $200 billion a year. It's an enormous company, yet revenue growth isn't just high, it's accelerating. It's going up. The growth rate is going up. It's just enormously powerful. Here's Netflix, up 10x in the last 5 years. And here's what the revenue growth rate is done. Not just high, but accelerating. The highest, and by the way, Glenn, they just reported earnings yesterday, the day before. So this does not have Q2, but
it was last week, and it's interesting. To several decimal points, the growth rate is exactly flat with what it was in Q1.
I.e., 40% again.
Correct.
Yeah, I don't know who is short this stock. A lot of people are short this stock. In fact, it had a 30% short interest at the bottom, a 50 bagger ago back in here, when they still had positive growth. But this was the whole Quickster debacle. This is the case study we're going to be teaching after the next one's going to be Google, Facebook. The only way you can be short this kind of growth is if you have conviction that there's going to be a sudden deceleration in growth. Because look, Netflix's growth is obviously going to taper off. It's not going to keep being 40% forever. But you've got to, as long as the revenue growth is super strong, this stock is going to stay trading at 16 times revenues, et cetera. So let's take a look at a value trap. Obviously, I've shown you a bunch of tech stocks with incredible growth. So IBM it was a terrible value trap that Warren Buffett stumbled into. I very rarely give him any kind of stock advice because he does not appreciate it. But I felt so strongly that he was making a terrible mistake with IBM that I wrote him a letter. I wrote him a couple different letters, outlining why this was a terrible value trap that he'd stumbled into. And finally, 5 years later, he realized it and sold just recently. So here's what IBM's year-over-year revenue growth looked like. And this is engaging in all sorts of financial engineering, making acquisitions, doing anything to try and get revenue growth up. And for 22 consecutive quarters, revenue declined year over year, quarter after quarter, for 4.5 years. This was the ultimate melting ice cube, and the company was doing all sorts of things to try and hide this, and adjusted EBITDA measures and all sorts of nonsense. I just couldn't believe that Warren Buffett was in this stock. Just in the past 2 quarters, revenue growth has turned positive for the first time in 5 years. But I think IBM continues to be a melting ice cube. And the stock isn't even that cheap. I mean, it looks cheap relative to other tech stocks. you know, at a mid-teens PE multiple, let's say, but that's just not cheap for a melting ice cube.
And Berkshire is now out of IBM.
Yeah, yeah. Buffett finally blew it out. So here's Google's stock. It's only doubled in the last 5 years, and we think it has not appreciated as much as it should in light of this growth profile. Growth is high and accelerating. This chart only shows through Q1 18, but they just reported a second consecutive quarter of 25% revenue growth. So high and accelerating growth for a company with now revenue run rate of over $130 billion. It's absolutely remarkable. And as we'll show you in our next slide presentation, the stock isn't even very expensive. So that's sort of accelerating growth and just a bunch of case studies and overview of it. Anyone have any questions before we move on? Okay, Glenn, do you want to maybe go through the initial slides on Google for 10 minutes, and then we'll pivot to Guy at about 8:45 as scheduled, or that makes sense?
That makes a lot of sense, so long as it's okay with Guy. He's our guest, so.
He seemed to indicate that it was okay, so I'm going to make an executive decision here. So let me pull up the Google Facebook slides.
Yeah, he gave us a thumbs up.
Okay, good. Thank you, Guy. Hold on just a second.
By the way, folks, it is a real treat to have Guy with us today. He's a wonderful investor, and more importantly, he's a wonderful person. And I'm sure you all know about him, but it's exciting to have him with us today.
I'm very good at inviting Glenn to my wedding. He'll tell you all about that.
It was a great wedding. So Glenn, I will run the slides. I don't know whether you want to just run through them super quickly in 10 minutes, or maybe we get halfway through and pivot to Guy, or whatever.
Well, let's see how it goes. So Google's stock price back when this was done was a little over $1,000 with a market cap of $800 billion. We're in a world that I've never seen before. We're seeing 500 billion to $1 trillion companies that are growing like weeds, that are beating expectations by big numbers, and as Whitney said, are accelerating growth. These are remarkable businesses. Google, sort of on a valuation basis, I think is one of the most remarkable. So out of that 800 billion, there's 100 billion of cash, a smidge of debt. So an enterprise value of $700 billion. And it doesn't look cheap on 2017 earnings, 36 times, and 2018, 26.5 times. There's a couple of reasons why we think first off, that may not be unreasonable for businesses of this quality. And second off, we think that that's understating sort of the intrinsic. So next.
So this is, sorry, Glenn, I should have updated this slide based on the earnings yesterday, but the numbers were actually pretty similar, weren't they, for Q2?
They were. Make believe this slide says Q2 earnings were exceptional. Next.
So let me, I'm going to very quickly go through this. Back in 2004, when Google first came public, I wrote a lot of really spot on good stuff. I'm generally proud of the couple hundred articles I wrote for the Motley Fool and a few other places. This is one that I just screwed up, probably the worst call ever. And I did not do the full work on Google and appreciate that there was a moat around the business, and I sort of heaped scorn on it. And what did I miss? That Google has enormous optionality. It's serving rapidly growing markets. It can expand globally with very little CapEx, and it does have a big moat around it, driven by this virtuous cycle here, where they have a large user base, which leads to a large advertiser base, which leads to better monetization, which leads to more R&D dollars, a better product, which creates high barriers to entry, which in turn attracts a larger user base. So what I thought was just a commodity business, hey, anyone can just use Yahoo versus Google versus Bing or whatever browsers were out there. I failed to appreciate that there are actually big network effects, big economies of scale, and they're winner-take-all dynamics here. This is revenue growth going back. It's up 30. Revenue growth since I wrote that stupid article, an embarrassing article. Revenue is up 35x since then, and is accelerating. Margins, I was correct actually that margins might contract a little bit eventually, but really they've been very high and stable. And not surprisingly, therefore, if margins are stable, then earnings have gone up 35x as well, if revenue goes up 35x, just mathematically. And that's translated into stock being a huge winner. So, Glenn, do you want to pick it up from here?
Yep. Okay, so we all know about the search and the dominance they have there. The second bullet point's kind of interesting. There's 7 products with more than 1 billion monthly average users. This is extraordinary. It's not just one company. Google Search has 90% share. I think it's pretty likely that they have a decent moat there. They are currently 14 to 15% of global advertising spending, which is a nice, healthy share. But what's really interesting is 100% of the incremental ad spending in the world is going to Google and to Facebook, 100%. So let's say that global advertising is growing at about 4 percentage points a year, and let's say that 60% of that is going to Google, which is probably about right. That means that 2.4 percentage point of global advertising will be the growth of Google year over year before organic growth. So in other words, they've got embedded 15% growth in this dynamic, even if they don't have any sort of underlying better monetization, better pricing, anything like that. So they've got a huge, huge tailwind in that. The next.
Hold on just a sec. There you go, Glenn.
Okay. YouTube is a tremendous opportunity. It's the world's second most visited website. My kids, I have 5 kids. My kids do not watch TV anymore. They watch YouTube. And it appears that they'll be at an inflection point now. And they are currently the most valuable video platform in the world. The average mobile users, you can see the statistics here, 40 minutes of average viewing. That's a off the charts kind of number. 15% of the gross advertising revenue is coming from video, but it's growing twice as fast as the base. And they're under monetizing intentionally to grow share. So the opportunity set for monetizing YouTube is absolutely enormous. So the question is really, what is YouTube worth? And there's a bunch of ways to value YouTube. You can value it as a multiple of revenues and compare it to something like the Netflixes or the Hulus of the world, the private market value of Hulu. You can value it on sort of what do you think the ultimate earnings power of YouTube is going to be if you superimpose the advertising rates that they get on their other platforms. But what is happening right now is it's combined and consolidated in the valuation of Google. So it's basically simply what is the net margin of YouTube times the PE ratio of YouTube. So right now, embedded in the $800 billion valuation, it's probably valued at around $17 billion or $25 a share. In other words, it's relatively insignificant. What do we really think that it's sort of worth? Probably about $200 to $300 a share based on those other sorts of metrics that I described. And put it this way, if YouTube was spun off today, it would be trading at $200 to $300 per share is what we think would happen. And that's, so the value is somewhere between 25 and a much, much, much higher number. And yet embedded in Google, it only looks like 25. Next slide. In addition, there's a bunch of other dynamics at Google that understates the earnings. There's a lot of analysts, of course, and it seems like a pretty high multiple. I think we skipped over the other bets, Whitney. Did we skip over the other bet slide?
That's a good question. Hold on just a second. Let me go back and There we go. My apologies. Yes, we did. There you go.
Okay, so embedded in Google is also other bets, and that depresses valuation in two different ways. One is it has an operating loss of $3.4 billion. So the PE ratio not only doesn't take into account the value embedded in these other bet businesses, but it also doesn't incorporate the dollars put in, sort of the sum of the parts valuation, the dollars that have been put into this these other businesses. The most well-known of these is the Nest thermostats, which have taken on a lot of share. Perhaps the biggest opportunity set is Waymo, which is their autonomous vehicle portion. In any case, these bets are taking $3.5 billion out of operations, and they also put a lot of money into these things that is completely not counted. We, in our valuation, are basically saying that they're probably worth about $50 a share, about twice what's been invested in them to date. So let me give you sort of a theoretical framework for how you could value Google if you wanted to look at it, with an optimistic mindset. Next page. Okay, so if you took a look at the other bets and you said that they're worth $50 a share, and if you added back the losses from them to net income, then Alphabet's trading at about 18 times 2018 earnings. But what about YouTube? If you think that YouTube should be valued separately, and in this analysis we valued it at $255 a share, which is which is I think it's that
was the Bill Nygren number.
The embedded value, the difference between the embedded value and the Bill Nygren value, then it sort of looks like Google's trading at 15 times 2018 earnings. So very, very look. This is too aggressive. This is not a margin of safety valuation. This is not a hardcore analytical. Google's trading at 15 times. I should buy it. But what this does say is that you can put a boundary between the 15 times and what the apparent 26.5 times 2018, and the right valuation is probably somewhere between there. So let's call that 20 times. And you want to pay 20 times earnings for a business that's growing 25% a year, that has unlimited growth opportunity and some secret hidden assets. Secret's a bad word. Some hidden assets that may have their value exposed over time. Yeah.
So Chirag has a question. Let's go ahead and ask your question.
Well, thanks. What I've seen since I've been researching the online advertising space, since it's closer to what I do in my day job, I've seen a slight shift, especially with incremental advertising spend, and the secret place that it's kind of started to flow now is on Amazon, with Amazon slowly opening up their Amazon Media Services that allows product companies to buy ads and push that. And I'm just wondering if you have, in your research of Google, kind of come across, a similar sentiment where, even though Google is very strong, and recently I even read an article where it said that 55%, so a larger number of people, are starting their product search on Amazon rather than a search engine, which to me kind of indicates that Google is strong, it's going to be there, it'll survive, but we may start seeing a lot of incremental coming in from, a little bit of that being eroded as companies start realizing, especially product companies, where they can directly not just have the search intent, but also know what the buyer intent is, given the data and the search capabilities that Amazon has, and now it's opening up to companies to leverage it.
Yeah, you could not be more right. That is absolutely right on point. And Amazon, that is yet another growth engine for Amazon. After
let me just show you, Glenn. Let me just pull up on the screen here. I just to your point. This is I just pulled this up and I searched for TVs on Amazon. and look at what came up. If you guys can see this, that the entire top part here is paid for by Samsung. See, it says sponsored by Samsung. So in other words, Amazon is now becoming an advertising business, not just a retail business and a cloud business. Search for any product you want, and you'll start seeing paid advertising related to searches. And the beauty here is that Amazon is able to charge a lot more money for this advertising than if you just went to Google and typed TVs, because the likelihood that someone is about to make a purchase when they do the search on Amazon is much higher than when they do the search on Google, right? And Amazon knows this. So this is a guy named Alex Sacerdote at Whale Rock Capital, pitched Amazon 4 years ago on stage with me when I was pitching Lumber Liquidators as a short. And those were two great ideas, a short that went down 90% and a long that's gone up probably 5x since then. But he was back at the Robinhood conference last fall. And his thesis, by the way, 4 or 5 years ago on Amazon, was that Amazon has this incredible new business called Amazon Web Services, and nobody's paying any attention to it, but it's going to be huge. And he was absolutely right. That's been a huge driver of Amazon stock, right? His thesis last fall was Amazon has this incredible new business selling advertising that nobody's focused on, and it's going to be a huge driver of the stock. And I think he's likely to be exactly right on that as well. Now, the question, I guess, is it's a reason to own Amazon or to continue to hold Amazon if you're lucky enough to own it, right? But then the question is does this somehow impair Google or Facebook's business? Does it reduce the value of those businesses? And I guess it is a competitor, but I think there's so much room here for all of them to win.
See, the issue is
right.
The issue is the pricing power embedded in Google and Facebook is so huge in my estimate. There's a reason why they have such share and they are growing such share, and it's because they're so effective. And that effectiveness almost definitionally shows that they haven't reached the marginal point where their pricing power is impaired. So they won't grow as fast as they would had Amazon not existed and entered into this business. And all three will be huge winners for the foreseeable future, in my judgment.